Welcome to our channel. Today, we're going to talk about a topic that often confuses people: 1% TDS in India. Let's get started. Before we delve into 1% TDS, let's understand what TDS is. TDS stands for tax deducted at source. It's a method used by the Indian government to collect tax at the time of payment. Different transactions like salary, interest, rent, and professional fees attract TDS. The purpose of TDS is simple: to ensure a smooth flow of tax revenue and curb tax evasion. By deducting tax at the source, the responsibility of collecting taxes falls on the payer. Now, let's talk specifically about 1% TDS. It applies to the sale of a movable property in India. When you sell a property, the buyer must deduct 1% of the total transaction value as TDS and deposit it with the income tax department. The process is straightforward. First, the buyer needs to obtain a TAN, tax deduction and collection account number. Then, they calculate 1% of the total transaction value and deduct that amount as TDS during the payment to the seller. Here's an important point to remember: the seller can claim a credit for the TDS while filing their income tax return. They can adjust this amount against their total tax liability. If their tax liability is lower than the TDS amount, they can request a refund from the income tax department. And now, a bonus tip. If you're selling a property and your net capital gain is less than 50 lakhs, you can avoid TDS by obtaining a certificate from the income tax department. This saves you the hassle of going through the TDS process. That's a quick overview of 1% TDS in India. TDS plays a vital role in the Indian tax system, ensuring compliance and revenue collection. If you found this video helpful, give it a thumbs up and subscribe to our channel for more informative content.